Here in the beginning, okay, once you have gone through the option strategies, everything else, now the question that you will all be asking is how does one decide upon this premium amount which is there? So the option premium, this is all buyer as well as in terms of seller. Okay, so you will be able to understand here with respect to this problem. Okay. This problem always talks about something called as moneyness. Okay, just we want to know if I have got three call option which are there with the different exercises prices, and you will be able to notice the premium amount also varies. Okay, this is the best example for it. So if I take one call option first, this is 100. Okay, but the spot price which is there is 105. Since if I go for this option, okay, if I go for in terms of this call option also, you will be able to notice this is nothing but in the money, and right in the beginning when I go for buying in terms of this call option, I am readily making 3 rupees as in terms of the profit, because the spot price is greater than the exercise price plus in terms of the premium. So you will be able to notice that the premium which is there is nothing but 2. Now you will be able to notice that if the markets are considered to be very bullish in nature also, you people are ready to pay more and more premium. Okay, so what happens here is you will be able to notice that if it is out of the money stock, okay, if it is out of the money, if the call option is considered, the exercise price here is 105. The premium amount which is there is 8 rupees. Okay, so that means the overall which is there 105 plus 8, 113 is nothing but is your exercise price plus premium. So you will be able to notice at any point of time in the market, if you go for any contracts which are available on any company or anything, you will be able to find three contracts which are there. One contract is one contract will be maturing in 1 month, another contract will be maturing in 2 months, another contract will be maturing in 3 months. So whichever has got the longer maturity, it is always referred to as far month contract. Whichever is have 2 months remains, this is referred to as in terms of mid month, and the one which will be expiring in 1 month itself, this is referred to as a near month contract. So what people always do is they will go for buying those contracts which have got 3 months. Their volatility will be very high. There is a possibility of making gains there also. So far month contracts is the one they will always go and invest. When it comes to near month contracts, since we are dealing with in terms of options which are there, you will be able to notice the volatility will be very less. So which means I'm saying that there might be some relationship between the premium that is charged on the call option with respect to what is the spot price expected or what is the spot price. And what we had done previously also is we had in investments, when we took the share prices, converted that into returns, we calculated correlation, we calculated standard deviation, variance, everything else. Here the belief is if the call option is what they are referred to as a derivative, because the value of the call option in turn will depend upon what will be the spot price. So which means thus they are referred to as derivatives, because they will derive their value based upon underlying assets which are nothing but whatever the spot prices that you have considered. So if the spot prices or the underlying asset which is there is considered to be too volatile in nature, so standard deviation is one which I will be able to consider. Second one is I will always consider, should I be able to go and invest in options when I had an option to go for directly stocks, or I can go for fixed deposit. That means when compared to risk-free rate, uh, that also has to be one of the component which is there. So you will be able to notice whenever one talks about uh, uh, the premium amount which is there, they will talk about two things. One is called as intrinsic value, and another is referred to as a time value. That means premium is believed to have two aspects. One is referred to as intrinsic value as well as in terms of the time value. So let's have a look at this problem. Okay, so this is a very simple problem, but will help you to understand the concept of what is called as intrinsic value as well as the time value. So if I go for this problem wherein they have said a 2-month call option, that means it will expire in 2 months on Infosys with a strike price of 2,100. So if it is the call option, and if the strike price which is there is going to be 2,100, he is selling for rupees 140, which means that the premium which is to be paid is 140. So you will be able to notice here, and there are some mistakes here in the problem also. You just have a look and correct it accordingly. So this is 2,240. Okay, this is nothing but is your exercise price plus in terms of the premium, and the what they have said is the share which is there is currently trading at 2,200. Okay, here it is 2,200 which they are saying. So you will be able to come across two terms which is referred to as intrinsic worth of the call option. So intrinsic worth of the call option is nothing but what we have said is, if this is going to be the exercise price, if this is going to be the exercise price, and this is going to be in terms of exercise price plus in terms of the premium, you will be able to notice, if I talk about the intrinsic value will be nothing but what is the spot price which is there minus 2,100. This is going to be 100 rupees. Okay, so you will be able to notice, if you go for buying the share, and if you look at the call option value right now, the if the exercise price, if the spot price is greater than the exercise price, the difference that you have, this is always referred to as intrinsic worth of the call option. But the premium that you are paying is how much? You are paying 140. That means 40 rupees more. So which means, if this gap which is there, if I am talking about this gap, and this gap, if I am talking about as intrinsic value, the extra 40 rupees that you are paying, this 40 rupees that you are paying is always referred to as the time value. Okay, so you have got intrinsic worth, but you are firmly of belief that the exercise price which is there are higher chances that this spot price 2,200 will go further, and you will be able to make more money greater than the exercise price plus premium. And for that, you are ready to wait for 2 months. Okay, it is a 2-month call option. So you are ready to wait for 2 months, and thus you are paying some extra amount of 40 rupees, and this is always referred to as time value. So when I talk about call option, when you talk about the premium value that is paid, the premium value always consists of intrinsic worth or intrinsic value of the call option or intrinsic value of the option, and it will consist of what is called as in terms of the time value. So when you combine these together, you get what is referred to as in terms of the premium. So it means that I'm expecting time period. That means the time period also plays a very important role. If the time period is not 2 months, if the time period is just 1 month, you will be able to notice the premium amount will automatically become less, because you know that within this shorter time period, the possibility of this 2200 to go beyond the exercise price plus premium will be very, very less. So that means greater the maturity time which is there, greater the chances that the premium amount will be higher, because your time value, or you are given more time so that this value will be able to go beyond the exercise price plus premium. So maturity time plays a very important role. The spot price which is there, what is spot price? Spot price is nothing but the stock. In investments, what we talk about is these shares will always move in a random way, and then if it moves in a random way, the variation which is there with respect to share is always given by standard deviation. If I am talking about standard deviation or in terms of variance, you will be able to notice that depending upon volatility, if there is another share and the volatility of the share is almost flat, there is no chances of you making any money because it is almost flat. Okay, but if there is more volatility, you will be able to notice that your chances of the spot price going beyond exercise price plus premium will also be higher. So more the volatility, there is more chances. So you will be able to notice volatility can also have an impact on the premium amount which is there, and thus spot price, the volatility of the spot price, the time period that it takes can have significant impact on the spot prices. And for that reason, what we always do is whenever we come across in terms of the options, we look at first one is we say what is this, if I'm deciding upon in terms of the premium, can I say the premium amount should be within this range? It should not be unrealistic in nature. It should be within some bounds. If I can calculate these bounds, this will be much helpful. Okay, so that I can decide. So if this is the case, the maximum value of the call cannot exceed the value of the asset itself. That is one thumb rule which is there. And the minimum value of the call is given as, so on what basis? You will be able to notice that when we talked about in terms of the spot prices, and when we talked about in terms of the exercise prices also, you will be able to notice whenever we talk about call option, what is the thumb rule for the call option that we have looked at is, when we look at in terms of the call option will be able to make money only if the spot price which is there is greater than the exercise price plus the premium. So spot price is always greater than the exercise price plus premium. Now the spot price, we are considering it when we are considering it 2 months from now. Okay, so that is going to be further away. This is going to be 2 months. Now when we are talking about in terms of the exercise price, what we are deciding here is we should be able to consider the present value of the share also. So present value of the exercise price. So the maximum losses that will be there, the lower bound of the call option which is there is maximum can be in terms of 0, but the minimum can be 0, and in terms of the maximum can be spot price minus the discounted value of the exercise price. So discounted value, when we did in terms of the time value of money, or when we looked at the timeline also, when we looked at the timeline 1, 2, 3, 4, you will be able to notice when we talked about the share prices, we always said the current value of the share. Okay, so when we looked at the current value of the share, we always discounted it. So if we discounted it, you will be able to notice if I want to calculate the present value is future value divided by 1 plus I raised to the power of n. This is what, if the compounding is done continuously, you will be able to notice it becomes future value divided by e power minus RT. Now if I take this on the top, you will be able to notice this will, okay, so you will be able to notice that since we are, this is positive e power rt, and if I take it in the numerator, this becomes future value into e power minus rt. So what it tends to do is, this formula will try to help you to get the present value of the share today. So if I want to go for the lower bounds, you will be able to notice they were always interested in taking the present value of the exercise price. So the spot price, today's spot price, minus in terms of the exercise price into e power minus rt, where r is nothing but the risk-free rate. So you will be able to notice, depending upon the time period that it takes, whether it um, the option which is there is for 1 month, 2 month, or in terms of 3 month, you will be able to notice what is the amount of premium that you might be able to expect will be decided based upon this, wherein it mainly talks about in terms of lower bounds and upper bounds. Upper bound is nothing but, in the put option, we know that the spot price which is there should always be lesser than the exercise price. Only then you will be able to make in terms of the profit. So it will be always XE minus RT minus in terms of the spot rate. So if you understand in terms of the lower bound as well as in terms of the upper bound, you will be able to come across what if the options which are there is with respect to stocks, and these certain stocks are able to give dividends also. If they give dividends, what is the slight change that we will be able to make is, you will be able to notice that anyways you are taking spot price minus exercise price into e power minus RT. So this is nothing but in terms of the lower bound. If the company is giving a dividends, and we always said that whenever we go for futures or in terms of the forwards, whenever we calculate the present value, dividend is always considered as a benefit. Benefit should always be deducted. So when we deduct in terms of the dividend, if dividend is given in rupees, for example, we will be able to take this formula, and we will be able to calculate the lower bound as well as the upper bound for the call options as well as in terms of the put options. But when we come across currency options, so when we talk about currencies, when I am talking about the exchange rate, you will be able to notice you have got two currencies which are there. One is home currency and another is in terms of the foreign currency. So if that is the case, we know interest rate parity. If the interest rate parity conditions is considered, what is the rate of interest which is there in a foreign country? What is the rate of interest which exists in the home country? So if I am able to consider within the formula, previously it was what? Spot price minus X into e power minus RT. But now what we are doing, we are taking the differential that exists between home currency as well as our home country with respect to that of foreign country in terms of the changes in the risk-free interest rate, and then we will be going for the lower bound. Now, lastly, what you should now be able to understand is, this is talking about in terms of the lower bounds as well as in terms of the upper bounds. But if practically, if on everyday basis, if one is able to come up with the premium prices for the options, okay, they will be coming across what is referred to as the binomial model, okay, and what is referred to as the Black-Scholes and Merton model. Binomial model which is there is very restrictive in nature, but practically throughout the world, for calculating the option premiums, Black-Scholes Merton model is the one that was chosen. So in economics, Black, Merton as well as Scholes, okay, all of them for their contribution, they were able to get in terms of the Nobel Prize also. So you will be able to notice binomial option. Okay, you might have heard this. in statistics, when you come across binomial option pricing model, so in binomial theory, what does it mean here is when you talk about binomial, since it is called as binomial, consider in terms of probability distributions that you went for, you had what is called as a binomial distribution. You had got Poisson distribution. You had got in terms of a normal distribution. Okay. Now, if this is the case, Poisson and binomial distribution are considered for a discrete values, whereas normal distribution is always considered for continuous. Now, when I talk about binomial here, what we are saying is, what is the probability, what is the chance that probability of a head, or what is the chance of probability of a tail. So you will be able to notice you have got just two aspects. One is either in terms of success or failure, head, or in terms of a tail. So if I am able to take this concept of binomial distribution and then adopt the same thing, so you will be able to notice when you come across specifically binomial option theory, since I have got 1D head or in terms of tails, so if I am able to get here as, once I have got the head, what is the probability of me getting head once again, or what is the probability of me getting in terms of tail? So if I am able to use this concept to find out what is the option premium going to be, this is always referred to as binomial option pricing model, wherein what a binomial option pricing model tries to take, if you look at in terms of this formula also, that what it is mainly concerned about is whether the call option that I'm taking, whether if the spot price is greater than the future spot price is greater than the current price, what is the expectation of it? And similarly, you will be able to notice you are taking the ratio of the future spot price divided by spot price, which means what it is trying to do is at any point it is trying to say what are the chances of just two things, whether it is going to be in terms of positive, whether it is going to be in terms of negative. So you will be able to notice the value of the option. If the future spot price is greater than the current spot price, CD is nothing but the value of the call option if the spot price, future spot price is lesser than the current spot price. If I'm able to take similarly the ratios of it, depending upon what I feel the spot price is going to be, what is the probability of whether the spot price is going to be higher or whether the spot price is going to be lower. So I'm taking in terms of two probabilities which are there. If I'm able to use this formula, this will be able to give me the value of the call option. But always remember that when I'm talking about binomial, it always takes into consideration just two aspects. But you will be able to notice this is very, very restrictive, right? You cannot just come up with whether it is greater or less than. So the most celebrated method which is always followed in finance, specifically on financial derivatives, is when we have to decide upon the premium. It is the Black-Scholes and Merton model, wherein it applies to European style options. So there are two kinds of options which are there, American option as well as European option. American option means if you go for, if you say you buy the call option, you need not wait up till maturity, 3 months. You can exercise that call option whenever you feel it. So American option can be exercised anytime. When it comes to European style option, we believe that you enter into the market on the date of issue and you will be able to exit the market on the time of maturity. That means exactly after 3 months. This is always referred to as European style option, since you know that the maturity is fixed, since you know that the time frame which is there is fixed. Due to that reason, it is possible for us to come up with the model. We can depict in terms of the model. So it applies for the European style option, and you will be able to notice what it does is it takes into consideration the volatility, but yes, the stock prices, when we were looking at the investments, the stock prices which are there, we did not take it directly. Instead, what we did is we converted that into written form. This written form of the data is always referred to as log normal distribution. So they always considered the log normal data, or in terms of the written form of the data. Once they calculated the written form of the data, they felt that volatility, the spot price, as well as the time to maturity plays a very important role in deciding upon the option price. And thus they came up with this formula for the call option as well as the put option. Now, very simple for you to understand is, when I go for the call option, what is the thumb rule? The spot price has to be always greater than the exercise price for me to exercise, okay, or make profit. So when I come to the call option, the spot price minus in terms of the exercise price, but I am trying to take the present value of the exercise price, which is nothing but x into e power minus RT. So lower bound, when we looked at previously, what it did for finding out the call option, it is nothing but spot price minus exercise price into e power RT. This is what we did. Now, what they are doing now is they are trying to say this is not enough because of the reason, that there might be certain things like volatility and risk-free rate that will play a very important role. And for that reason, what we should be able to do is we should be able to take the ratio, which is nothing but spot price divided by in terms of the exercise price. We should be able to take the log series. Then we are saying that the call option will also depend upon what is the risk-free rate. They will also believe that the variance, or in terms of the standard deviation, also plays a very important role. And the time to maturity which is there, the more the time period, the more it is to be considered. So if that is the case, you will be able to notice when I do come up with this equation ND1, what it means here is, that we are taking into consideration time period, volatility, as well as the risk-free rate into consideration, and then making in terms of the decision. So just a minute. So this is nothing but in terms of the D1. Once you have calculated in terms of the D1, D1 minus the standard deviation of the root T will be able to give you in terms of D2. So what yeah, they came up with the formula that volatility, time to maturity. So time to maturity as well as in terms of volatility, you will be able to notice more the variance which is there with respect to an underlying asset, okay, whichever the underlying asset is, more in terms of the variations and more the time which is there, you will be able to notice that there is more chances that the spot price, because if this turns out to be positive, this is S into ND1. So if this turns out to be positive, there are higher chances that your probability that the spot price will be greater than the exercise price will be very, very high. Okay, so for that reason, if you take the one of the I'll be sending in terms of that example, I did not put it here. So if you take one of the examples also with respect to this option, so you will be able to notice when I calculate this D1, if there is this is nothing but log normal, I'm taking the log normal of it. So if I take log normal of D1, you will be able to notice more the value, more in terms of the volatility, more the value that I get here, there is higher possibility that your premium amount which is there, or your chances of making profit will also be higher. And then the premium will also be decided accordingly. Similarly, when it comes to put option, what is the put option? The exercise price minus the spot price. So if the spot price is lesser than the exercise price, only then you make the profit. So you'll be able to notice the present value of the exercise price minus the spot price is nothing but premium, lower bounds. That what we are doing is we are taking in terms of negative D2 as well as negative D1, because in this case what we are trying to do is we are trying to take on the other side. So if I'm taking in terms of log normal of negative D2 as well as negative D1, you will be able to arrive at the option price. So this is the method which is the most popular. All the exchanges, if you look at when they are coming up with the option premiums, and if these premiums are changing very, very often, why are these actually changing very often is for the reason that underlying formula, when they go for it, is completely dependent upon variance, risk-free rate, as well as the time period which is there. So the more the time period, the more the variations, you will be able to notice that there is a better chance that your call option that you have invested in will be able to result in premium amount. So this is what I wanted to discuss. And in terms of options, there are in order to tell that the option pricing which is there is sensitive to time period, it is sensitive to standard deviation, it is sensitive to spot prices, it is sensitive to in terms of all these aspects which is there. The sensitiveness of the call options as well as put option to all these spot price, standard deviation, variance, time period, everything else is always reflected by some key terms. This is referred to as always, you will be able to notice here, this is always referred to as in terms of the option Greeks. So if you come across this term which is referred to as option Greeks, there are various things like delta, vega, theta, everything else. If you come across these terms, it just means that they are trying to say if the premium prices are affected by these values, the sensitivity of the option prices to each and every aspect, which is nothing but spot price, time to maturity, volatility, and risk-free rate, is indicated by each terms. Okay, these are referred to as in terms of option Greeks. So they will try to look into delta, vega, theta. Okay, so rho, they will be able to come up with various option Greeks and try to examine whether it is going to be favorable or not favorable whenever they go for making such calculations. So